Heartland Corporation manufactures flour milling machinery according to customer specifications. The company operated at 75% of practical capacity during the year ended with the following results. And we see that sales revenue was $12,500. There were sales commissions paid equal of 10% of that amount to derive net sales of $11,250. Then we have various expenses appearing down here, some variable, some identified as variable, some identified as fixed. And we derive total cost, determine income before taxes of $2,250. This is all in thousands now. And $900 of income taxes. So net income was $1,350,000. Now, Heartland expects continued operations at 75% of capacity, and they recently submitted a bid of $82,500 on custom designed machinery for Premier Foods. Heartland uses a pricing formula in deriving a bid amount, the formula based on last year's operating results. Let me slide down so we can see that. And we'll just take it down to requirement 2 here. Okay, so we see that there's an estimated direct material cost of $14,600, estimated direct labor of $28,000, estimated manufacturing overhead at 50% of direct labor at $14,000. Now these are all in thousands, of course. So really these are 14.6 million, or 28 million, 14 million, and unless I've misinterpreted that, and we'll find that out in a minute here. So we wind up with estimated total cost excluding sales commissions of $59,400. I'm just going to state them in the actual whole dollars that we see. We add 25% for profit and taxes, and we wind up with a suggested price with profit before sales commissions of $74,250. So if we adjust that, divide it by 90% to account for the 10% commission, we see that the formula approach says the suggested total price should be $82,500. Now in requirement 1 they say calculate the impact the order would have on Heartland's net income if the $82,500 bid were accepted by Premier Foods. And let's take a look at that. Okay, now you see on the screen the solution to parts 1 and 2, and let's focus on parts 1. The order would boost Heartland's net income by $13,950, and here you can see the calculation. The sales revenue is $82,500 to the left of my mouse. We're paying a 10% sales commission, so that nets us $74,250. And then there's manufacturing costs to consider. $14,600, $28,000, and $8,400. And we only need to include the variable manufacturing cost. Okay, if we looked on the analysis of the year just ended, variable overhead was 30% of direct labor. 1,125 divided by 3750. Okay, so if we take the 28,000 times 30%, we have an $8,400 variable manufacturing cost to consider. So our total variable manufacturing cost, or our total incremental cost as a result of taking this order, is $51,000. Subtract that from our sales commission, we've got income before tax of $23,250. 40% income tax is $9,300. Now we're just simply multiplying $23,250 times 40%, and we wind up with net income of $13,950. Okay, now back here at the bottom here, let's focus on the second requirement, and it says assume that Premier has rejected Heartland's bid but has stated it's willing to pay $63,500 for the machinery. Should Heartland manufacture the machinery at this counter offer? And let's take a look at those answers again. Okay, now we'll focus on the solution to part 2. And still it makes sense to take this order on. Now it's below the $82,500 full cost price, but it's still profitable. It's $63,500. We've got commissions at 10%, brings us to $57,150. Then our direct material costs are all going to be the same as what we've seen above, right? $51,000, $51,000. So we still have a positive income before tax. We subtract out tax, and we're still ahead of the game to the tune of $3,690. Okay, now I've slid back to the problem again so we can focus on the requirement 3 and 4 that you see where my mouse appears. 3 says, at what bid price will Heartland break even? And 4 says, explain how the profit performance in the coming year would be affected if Heartland accepted all of its work at prices similar to the $63,500 counteroffer. Alright, let's tackle the break even first. Okay, so here's how you'd come up with a break-even price. It turns out to be $56,667. If we use P, meaning the break-even price, and P stands for price here, price minus 10% P gives us a net price minus 51,000 equals 0. And we know that 51,000 is the variable cost. Alright, so 0.9p equals 51,000, so p would equal 56,667. And that's how we would determine break-even. Now, on number 4, we're asked what would happen if we accepted that other price for all business, and profits would probably decline. Heartland originally used a full cost pricing formula to derive the $82,500 price. So if we sell the price at the $63,500, that signifies that pricing is significantly lower than full cost. We'd expect that to decrease profitability. Now, reduced prices could lead to an increase in income if the company were to generate additional volume. So we really don't know what the correct answer is. There's a volume positive effect and there's a price negative effect. But the situation won't occur here because the problem states that Heartland has operated and will continue to operate at 75% of practical capacity. So that's telling us the volume won't change.